This is the Retirement Solution Podcast with financial advisor John Hicks, founder of J. Hagan Capital.
And I'm Heather Branch here with John to ask him about the things you can be working on now in effort to better prepare for your financial future. RetirementSolutionRadio.com is where you can go to begin your own conversation with John and his entire team at J. Hagan Capital. You can also find links to click on in our show notes, or again, that website, RetirementSolutionRadio.com.
When you have taxes taken, you get a job every week, and they just take the taxes out of your check. They just take it. You don't get a choice. They just take it, and they keep taking it to the end of the year where they're like, hey, I think we might have took too much. Here's $500 back. Go buy yourself some sneakers or something. And you're like, thanks, government. We're going to Red Lobster tonight. This is amazing. I love tax time.
So that is Michael Che, famous comedian. If you don't know the name, you know him from his weekly co-anchoring on Saturday Night Live. He has Weekend Update. Yes.
Yeah. You know, it's interesting. So I guess he's one of the two now. Before them, the big one was Norm Macdonald. And of course, if you remember before that, Dennis Miller.
That's right. So many big time comedians have come out of the anchor desk of Saturday Night Live.
Chevy Chase up there, I think, was up there for a short period. It was slightly different.
Okay, got it.
But he did a little something.
Well, I appreciate it. That was Michael doing some stand up. What I thought was interesting is his take on it and how did you hear his thing? He was like, I love tax season. And I was like, this is what's wrong with our perspective on taxes, John. Like, he's over here being like, I love tax season. Just got my $500 bonus check. That's not how it works, Michael.
I know. Isn't it crazy? I know. Basically, what you do is you give the government, if you get money back, you're giving them an interest-free loan for potentially as much as 12 months prior to when they pulled it and took it away from you. Mm-hmm. And yet, that's the way the system works. Gotta love it.
And we're also happy and grateful at tax season. Like it's the system. They're like, we've got them. Here's what we're going to do. We're going to make them think that it's working for them when really we've given them the loan.
Absolutely. But that's just the way it goes, because so many of us, it's so hard, to put money aside, know, in that savings account. Hey, I get it. Every time I turn around, my kids, whether it's for soccer or school or this or that, they're always asking for extra money. Mm-hmm. Sometimes it's a little tough unless you have one of those forced savings accounts like your 401k or something like that to stack money away. So I kind of get it. I kind of get the idea that, hey, when you get a refund check back, it's like a big deal. Yeah. But it's not a big deal that's good for us, sadly.
Like our minds are twisted. Our thought process is warped around taxes. Another tax conversation that I wanted to ask you about is this article I was reading about recently, because I had never heard this concept before, so I wanted you to go into some of the details on it. Yeah. This year, retirees are enjoying 8.7% more in Social Security benefits thanks to the biggest cost of living adjustment, that COLA adjustment that happened. Sure. It's the biggest one in over 40 years.
Oh, yeah.
But of course, there's always a flip side. Whenever benefits are increased, more seniors are pushed into higher tax brackets, and financial planners, they call it a stealth tax. So can you clarify this idea, this notion of stealth tax? And also, is there ways that we can watch out for this? How do you help folks consider this when figuring out their overall financial and retirement plan?
Yeah, so when you're looking at tax analysis, this is one of the things that unfortunately, and I mean unfortunately, even the best bookkeepers, CPAs, accountants, people that help you with your taxes, even the best of them don't often have enough time to do proper tax analysis, because most of their time is spent just looking at what you did last year, quantifying that, and putting it in the system to find out how much you owe and so forth. But when you're looking at the analysis, this is the most important thing. This is what my firm spends so much time focusing on. Because, Heather, they're talking about a stealth tax, and this is not a new thing. This is not even remotely new. But what it is by not either understanding or being able to control your current tax bracket. Okay. Mm-hmm. So for instance, if you actually had higher payments by even $1 more, you might be moving from the 12% tax bracket to the 22. Jeez. Now guys, that is a 10% marginal tax rate difference. That is huge. As a matter of fact, that is the most egregious of the entire tax system, because once you go from 10 to 12, then you go from 12 to 22. then you can have almost as much as $380,000 of income to only go, Heather, from 22% to 24%. That's just a 2% difference. To me, that difference to go from the 22 to the 24% bracket, it might be the sweet spot of the current tax code. But if you don't know these things, or if you haven't been made aware of these things, it might cost you tens of thousands or even hundreds of thousands of taxes over the years, simply because we know that we can do things like bracket management, where we're purposefully trying to get our clients' income in a way completely honestly, ethically, to get them in a place to where we can know exactly what tax bracket we're going to stay in. But Heather, not only do we know where they're going to be, we want to forward look and try to figure out, okay, is there going to be a point 3 or 4 years from now where we might be able to take an opportunity and shuffle a ton of money and maybe save hundreds of thousands of dollars in the long run? That is not only just doing smart tax management, but it starts with the analysis. What are our opportunities? Because a lot of folks say, well, John, I got plenty of income. And in retirement, I think I'm going to be perfectly fine. Great. What are you doing then to maximize your current tax bracket? You can either do bracket management, or you can do bracket bumping, where you purposefully go, like I mentioned a minute ago. Maybe the 22% bracket is fine, but maybe you want to take advantage of the system and bump that next tax bracket to go up to 24%. Why would we do that? Because that's just a 2% tax difference now. And ladies and gentlemen, when the new tax code comes back in a couple years, that you could be as high as the 32 to 35% bracket for something that we could simply change now. So those are the things that we want to find out about. Can we take advantage of those situations? So this was one of those things where the cost of living adjustment, or COLA, that people got on their Social Security bumped them up to the higher bracket. One of the things that unfortunately so many people in my industry just do not understand is that if you own mutual funds and they're not in an IRA or a Roth IRA, ladies and gentlemen, you may be paying a worse than a stealth tax. You may be paying phantom income taxes, where literally you could have losses in that mutual fund and still owe fortunes in taxes on those losses.
You had brought this up before, and I cannot wrap my brain around it.
Absolutely. So if you think about it, the way that mutual funds work, it's not like a stock. If you own a share of Apple stock and it goes up and you don't sell it, there really isn't any taxes due. There's no taxes due unless you sell it. Now, if you sell that Apple stock and it went up $100, the government's going to say, hey, you owe us some money because it went up in value. Okay? Right. But if you own a mutual fund is a very different tax environment. And so everything that happens in that mutual fund have a taxable consequence. And does that mutual fund company pay those taxes for you? No. They pass it right through to us. And so what does that mean? It means they could actually have made many buys and sells in that mutual fund, even though they lost money that year that can cost you tens of thousands or even hundreds of thousands of dollars. There was a young lady that came in. I say young lady, she just turned 73. And we were looking at trying to figure out how we can now work with some of her RMD money. And she said, John, here's the thing. I have no idea. I lost 19% in this mutual fund last year, but I've got this tax bill. Is that right? And I was like, oh my gosh, I know exactly what this is. But Heather, I did the research on this. Unfortunately, this wonderful lady was basically only getting a third of the returns of that mutual fund because so much of it was eaten up in taxation on that account. She had over $1 million in this fund. And of all of those dollars, she was really keeping only a third of the gains that it was reporting because of all the taxes that she'd been paying over the years. And guys, that's like basically having a 2/3 tax, 66% tax, simply because it was not efficient. Now, what would her alternative been? Instead of that mutual fund, she could have had something very similar called an ETF, an exchange traded fund. And they operate almost exactly like mutual funds with one major difference: how they're taxed. They're often very affordable too. Some of the best ones by companies like Vanguard or iShares, they're a fraction of the cost of mutual funds. Some of them only cost $300 for every $1 million you own. So they're super affordable in comparison, and they don't have those tax issues. So when we're looking at all these things, whether it be a stealth tax, because we really don't understand how that income is taxed, or whether it's phantom income taxes for assets that we own, loan where we can pay taxes on even an account that lost money, guys, we can do better than this. And it's not your current guy's fault. They are just not skilled at looking at the tax angle. We all deserve better than getting no tax advice at all. So consider if you have saved over $500,000 towards retirement, you have probably graduated from using mutual funds. You should be using individual equities, exchange traded funds, certain types of fixed and guaranteed annuities, certain types of individual bonds where you're not using funds that cost you more, are completely tax inefficient, and frankly can blow up your retirement future. If you want that analysis done, make sure you call my team so they can find out and just show you exactly where you are and what you might be leaving on the table so that you can find out all the completely myriad ways that you can get to where you want to go for your retirement future.
Thanks for listening to the Retirement Solution Podcast with John Hicks. Begin the conversation about your savings plan with John and the team at J. Hagan Capital by visiting retirementsolutionradio.com. Be sure to listen to John's radio show, The Retirement Solution, Saturdays at 8 a.m. and Sundays at 9 a.m. on News Radio 840 WHAS.
J. Hagan Capital Inc. is not licensed in all 50 states. To find out if J. Hagan Capital Inc. is licensed in your state, please call 502-690-5635. J. Hagan Capital Inc. is not affiliated with nor endorsed by the Social Security Administration or any other government agency. It does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Jonathan Hicks, insurance license number 548962.